By 2030, physical cash could be functionally extinct in over a dozen countries. Not declined. Not reduced. Gone. And the system replacing it is already being tested on hundreds of millions of people right now, most of whom have no idea it is happening. Welcome to the future of money. And it is arriving faster than almost anyone predicted. In the next 10 minutes, you are going to discover how digital currencies are quietly reshaping the global financial system, why central banks around the world are racing to launch their own versions, and what this means for your savings, your privacy, and your freedom. There is also one deeply uncomfortable truth buried inside this story that the financial mainstream rarely acknowledges, and we are going to get right to it. To understand where money is going, you need to understand where it came from. For most of human history, money was physical. Shells, gold, silver, stamped coins. Something you could hold in your hand. The value was either in the object itself or backed directly by something tangible. Then came paper currency, a promise from a government that the paper in your pocket represented real value. Most people accepted that promise without question. And for a long time, it worked reasonably well. Then came the digital age. Long before Bitcoin or blockchain entered the conversation, money was already becoming digital. When you swipe a credit card or send a bank transfer, no physical currency moves. Numbers change in databases. By some estimates, over 90% of all money in existence today is already purely digital entries in ledgers controlled by banks and financial institutions. So in a very real sense, the digitization of money is not a future event. It already happened. What is changing now is who controls those digital systems and how they are structured. This is where cryptocurrency enters the story. In 2008, an anonymous person or group using the name Satoshi Nakamoto published a white paper describing Bitcoin. The core idea was radical, a form of digital money that required no central authority, no bank, no government. Transactions would be verified by a decentralized network using cryptography. The system would be transparent, immutable, and open to anyone. It was a direct response to the 2008 financial crisis, a moment when millions of people watched banks collapse under the weight of their own reckless decisions while governments bailed them out with public money. Bitcoin launched in 2009 with almost no value. By November 2021, a single Bitcoin was worth over $68,000. That is one of the most dramatic increases in value of any asset in recorded financial history. Along the way, thousands of other cryptocurrencies emerged. Ethereum introduced programmable smart contracts, allowing developers to build entire financial systems on top of blockchain infrastructure. Stablecoins pegged to the dollar offered the benefits of crypto without the wild price swings. The ecosystem exploded in complexity and scale. But here is what nobody talks about when they discuss cryptocurrency's rise. The very success of decentralized finance caught the attention of the one group it was designed to challenge: governments. And governments do not watch a new financial system grow to trillions of dollars in value and simply look the other way. Central banks around the world began working on their own digital currencies. These are called central bank digital currencies, or CBDCs. And this is where the story gets genuinely complicated. As of 2024, over 130 countries representing more than 98% of global GDP are actively exploring, developing, or piloting CBDCs. China has already rolled out its digital yuan to hundreds of millions of citizens. The European Central Bank is deep in the development phase of a digital euro. The United States Federal Reserve has been studying a digital dollar with considerable urgency. On the surface, CBDCs sound like a simple modernization of existing currency. Faster payments, lower transaction costs, better financial inclusion for people without bank accounts. Those benefits are real. In countries where large portions of the population remain unbanked, a government-issued digital wallet accessible via a basic smartphone could genuinely transform economic participation. That is not spin. That is a legitimate use case. But dig deeper and you find a set of capabilities that have no historical precedent in the relationship between governments and citizens. A CBDC is programmable money. That means the issuing authority can, in theory, attach conditions to how it is spent. Money that expires if not used within a certain period. Money that cannot be spent on certain categories of goods. Money that is automatically taxed at the point of transaction. Money that can be frozen instantly, without a court order, if the holder is deemed to have violated a rule. Every transaction would be fully visible to the issuing authority. There is no equivalent of a cash transaction, private, anonymous, final. Every purchase, every payment, every transfer becomes a permanent data point in a government-accessible ledger. This is not speculation. These capabilities are explicitly described in the technical documentation published by central banks themselves. China's digital yuan system already includes features that allow authorities to monitor spending patterns and restrict usage in specific circumstances. This is not a theoretical future scenario. It is operational today. And the design philosophy behind China's system is influencing other nations' approaches more than Western governments generally admit. Now here is the genuinely uncomfortable truth that gets glossed over in mainstream coverage. The tension at the center of this entire story is not really about technology. It is about power. Who controls money controls behavior. For millennia, that control was imperfect. Physical cash could move without oversight, wealth could be stored outside the system. Digital programmable currency eliminates those gaps entirely. The question is not whether this technology will be built. It will be. The question is what constraints will govern its use, and whether democratic institutions are strong enough to enforce those constraints against the entities doing the building. On the other side of this equation, decentralized cryptocurrencies present their own serious challenges. Bitcoin's energy consumption rivals that of entire countries. Crypto markets have been vectors for massive fraud. The collapse of FTX in 2022 wiped out billions of dollars belonging to ordinary investors. Volatility makes most cryptocurrencies impractical as everyday money. Regulatory frameworks are inconsistent across jurisdictions, creating enormous uncertainty for businesses and individuals alike. The real financial future is unlikely to be purely one or the other. What analysts are increasingly pointing toward is a layered system. Central bank digital currencies handling everyday domestic transactions. Regulated stablecoins facilitating cross-border trade and payments. Bitcoin and select other cryptocurrencies functioning as decentralized stores of value, a kind of digital gold held outside the banking system. Each layer serving a different purpose for a different need. The transition will not be smooth. Developing nations face the risk of currency displacement. If citizens can easily hold digital dollars or digital euros, they may abandon unstable local currencies, stripping governments of monetary control. Countries with strong currencies gain leverage over countries with weak ones in ways that could reshape geopolitical power dynamics over the coming decades. For individuals, the practical implications deserve serious attention. Digital literacy is becoming a financial survival skill. Understanding wallets, private keys, custody arrangements, and the distinction between decentralized and centralized digital assets is no longer niche knowledge for tech enthusiasts. As physical cash disappears from daily life, these concepts will matter to everyone. The people who understand this transition early will have meaningful advantages in protecting and growing their wealth through it. Financial privacy, once taken for granted, is rapidly becoming something that must be actively defended. The tools for doing so exist today: hardware wallets, privacy-focused cryptocurrencies, decentralized exchanges, but they require deliberate effort to understand and use. The window in which those tools remain freely accessible may not stay open indefinitely. What is certain is this: the money system the world operates on for the next 100 years is being designed right now. The decisions being made in central bank research departments, in congressional hearings, in blockchain developer communities are not abstract policy questions. They are decisions about the structure of economic freedom itself. That is not an exaggeration. It is precisely what is at stake. The future of money is digital. That outcome is settled. Before you go, if you learned something valuable today, hit that like button right now. Subscribe to Trend Now Daily for a brand new video every single day. We will see you in the next one.